Valentine's Day on Tuesday the 14th, and there's lots of corporate and macroeconomic news to cuddle up to in the week ahead. Top down, the big feature of the week will be the latest UK inflation figures on Tuesday the 14th itself. Remember that the headline Consumer Price Index rose 1.6% year on year in December, as it crept ever closer to the Bank of England's 2% target. Also keep an eye out for UK unemployment and pay growth figures on Wednesday the 15th, US inflation numbers on the same day, and then UK retail sales numbers on Friday the 17th. Bottom up, meanwhile, 5 FTSE 100 firms are due to offer results or trading updates in the week ahead, including Centrica and Reckitt Benckiser on Monday the 13th, and Coca-Cola, HBC and Shire on Thursday the 16th. But for me, the company really capable of causing a fuss is Rolls Royce, which is due to release its fourth quarter and full year figures on Tuesday the 14th. Investors have been finding it hard to show the FTSE 100 saw too much love of late. As we can see from this 5-year chart, the shares have fallen from nearly £13 a share to less than £7 amid a series of profit warnings, corruption allegations in the US, UK and Brazil, and a change in accounting standard known as IFRS 15, which means that from 2018 onwards, the company has to recognise revenue from long-term engine contracts more slowly than before. Chief Executive Warren East has been grappling with all of this since he took the reins in July 2015, and last November's analyst meeting offered some grounds for encouragement he was making progress with his multi-year turnaround programme, cutting costs, changing the culture of the company, and setting a long-term vision for the business. But when it comes to the 2016 numbers, you need to look at 4 things. First, the order book, which was just under £80 billion at the end of the first half. Second, operating profit. That was £1.4 billion in 2015, and the company's forecast the figure would roughly halve in 2016. Third, the company's targeting cost benefits of around £150 to £200 million for the year just finished. And finally, watch cash flow. The coming accounting change shouldn't affect this at all, but at November's meeting, East did suggest cash was developing better than expected. Net debt ended the first half at £712 million, though the firm now has fines to pay of $497 million to the Financial Conduct Authority and $169 million to the US Department of Justice. Now, in terms of its operations, Rolls has 5 businesses. Civil aviation, where demand for new engines may just be softening at a slightly inconvenient time. Power systems, where industrial engine demand seems mixed. Defence, where the outlook seems stable. Marine, where a recovery in the oil and gas market would be very welcome. And nuclear, where, let's face it, few energy plants are being built, but submarine activity could be picking up. This final chart shows how each of those 5 units did last year when underlying operating profit at group level was around £1.4 billion. Remember, that's the figure expected to have halved in 2016. Civil aerospace, power and marine all fell in 2015, while defence was flat and nuclear was up. In sum, this is a complex company with big reputational, financial and operational challenges ahead of it. And this set of figures will be boss Warren East's next chance to show he's capable of turning things around, and his record at ARM, albeit a growth company, was excellent. In case East offers any forecasts for 2017, by the way, the analyst consensus is for pre-tax profit of around $850 million against $670 for 2016, and analysts seem to think the dividend per share will bottom at around 11.5p a share after a second cut in 2016. Thank you for watching, and I look forward to seeing you next time.